path to economic recovery is the clearest it's been in more than a year. Vaccinations for COVID-19 are readily available, and governments are lifting restrictions. People are returning to restaurants, to ballparks, and soon to entertainment venues. For the first time in a long time, we can, in some settings, see each other smile again. But emerging from a recession doesn't come without its challenges. Companies that shed employees quickly when the pandemic hit are struggling to find the workers they need to ramp up again. Construction, manufacturing, and other industries that never slowed down are grappling with supply chain issues, in addition to workforce challenges. Worries of inflation are becoming more common, and housing shortages persist. But we are Spokane. We are Coeur d'Alene. We are the Inland Northwest. At the Journal of Business, we endeavor to keep you, our readers, informed on what's happening in our community. Our staff is dedicated to providing you with objective information on news and trends, with the goal of helping you be more successful on your chosen path. It's time to go beyond the sound bites. It's time for more depth than 140 characters can provide. It's time for elevating the conversation.
Well, good afternoon and welcome again to Elevating the Conversation. My name is Paul Reed and it's an honor to serve as publisher of the Journal of Business. It's also an honor to me that 200 to 300 of you have chosen each month to sit down with us and have some great conversations. You know, we launched Elevating the Conversation for precisely that reason. You had asked us to create a venue in which we could have conversations about important issues facing our economy and our community. Since January, we've talked about the convention business amidst a pandemic with Spokane Public Facilities CEO Stephanie Curran. We've previewed the vaccine effort and the process with Dr. Frank Velazquez, interim health director at the Spokane Regional Health District. We've had meaningful discussions really through a lens of the business community about equity and inclusion and diversity with NAACP president here, Keonta Duncan. And last month we explored the complex and nuanced, I guess, reasons behind our housing shortage with prominent developer Jim Frank. Next month, we tackle another challenge of our community, and that's the stressed, near crisis talent pool we have in our employment sector with Robert Half's local leader, Jennifer Connick. And we have many more great events later this year. We hope you join us. But today, I'm very pleased to have with us Steve Scranton, Chief Investment Officer and economist with Washington Trust Bank, for a mid-year check-in on an evolving economy and hopefully a robust conversation about what building a post-pandemic economy might look like. As you know, Steve is one of the go-to economists in our region. I can say with some certainty that most of us in the business community are hungry for any information about the economy and where it's at now and where it's headed. This should be a compelling discussion, and I look forward to hearing your questions for Steve. But before we get to that, I'd like to thank this month's sponsor for elevating the conversation. We don't get to do these kinds of things without the help of some great organizations in our community. And this month, that organization is STCU. We are so appreciative that you allowed us to be able to do this kind of thing. Thank you. And today we have with us STCU's Chief Marketing Officer, Marty Dickinson, to say a few words. Welcome, Marty.
STCU is pleased to sponsor the Journal of Business Conversation today with Steve Scranton of Washington Trust Bank. This is a really important topic we are covering: rebuilding a post-pandemic economy. The last 14 months have been incredibly challenging for our region, for our economy, and for so many of our local businesses. As we look forward to rebuild and recover, we must move forward together with a coordinated approach and a coordinated plan. This takes collaboration and a willingness to come together as we have done so many times before as a community. STCU and Washington Trust Bank have united this past year to support things like the Inlanders Back to Business initiative. And most recently, we created and led the Great Dine Out, bringing 13 other financial institutions together, all of us helping one of the hardest hit industries in 2020. We have chose to put competition aside at the right times to collectively lift up our region. This type of partnership will lead us forward to a better and brighter future. Our special thanks to Steve Scranton and of course to the Journal of Business for bringing us together today.
Welcome to Elevating the Conversation. My name is Lynn Parrish. I'm the editor of the Journal of Business and your host for the next 45 minutes or so. I'm here with Steve Scranton from Washington Trust Bank. Welcome, Steve.
Thanks, Lynn.
How are you doing today?
I'm good.
Good, good. I've been looking forward to this conversation. I watched your economic forecast for GSI in April. And honestly, when I watched it, I thought, oh man, what are we going to be talking about in May? But even though it's been 6 weeks, it feels like there's only 6 weeks. It feels like there's a lot that's changed in that time.
Definitely.
One of the things that comes to my mind first is the job market. And so I wanted to talk to you a little bit about that. What we were talking about even in early April was kind of a tiered job market where industries that were low on employees and other ones that hadn't yet brought theirs back. Now it feels like everybody's looking for help. Is that your assessment?
Well, if you drive around Spokane, you clearly see a lot of help wanted signs. It is a case when we look at Spokane as a whole, Spokane has recovered 96% of the jobs they lost during that February-March pandemic time.
Mhm.
But it's still at tiering that if you look at the leisure and hospitality sector, it's 87%. You look at healthcare, it's like 106%. And then
Boy.
construction is 104%. And there's definitely areas like that, especially the what I call the trades type of jobs, where this is a chronic problem. It isn't unique to the pandemic, but it sure has been amplified by that. And it's not all to blame for the unemployment benefits. That's the favorite scapegoat.
Sure.
But there's a variety of reasons because of this pandemic. One of the major ones is because schools still are not fully open. We've got cases, especially for the female part of the workforce,
Mhm.
having to stay home to either help school their kids or because they don't have daycare.
Sure.
It's things like that. It's cases where maybe the type of job, even though it's in their industry, the one I always talk about is like construction. Well, if you're a carpenter, but where the need is for drywallers, you could say, well, we've got all these unemployed over here. Why aren't we filling the jobs? It's because there's skills mismatches as well.
Sure, sure. So now that we have a date, we have June 30th, we're supposed to be fully reopened in the Washington state at that time. Are you seeing hospitality trade jobs come back faster than you anticipated, or is this what you expected?
I think it's pretty much on course. I mean, I would expect, of course, as the unemployment benefits run out as well, that we'll probably see that accelerate more. But I think that especially from the restaurant side, as they've moved now, and we managed to stay in phase 3, operating at 50% capacity has given them the ability to grow their business back some. But
Sure.
I think until we really get back to being fully open, we're not going to really know the full damage there, especially for the leisure and hospitality. How many of these restaurants or hotels and stuff that are temporarily closed are permanently closed because of the
Right.
length of time it took to do that?
Right, right. Talking about employment, you wrote a piece for us a year ago. We published it almost to the day a year ago. And what we'd asked you to do is write a piece to say, we're in the depths of this recession. It was pretty much as bad as it got at that time. What are some of the economic indicators or numbers we should be watching for progress? And one of the areas that you talked about was initial claims for unemployment benefits.
Right.
We've been watching those closely, our staff has, and it looked like they were trending pretty clearly downward, but they've actually been up fairly substantially the last 2 weeks. What do you make of those numbers at this time?
Well, I think there's a problem now, and I've actually changed a little bit from saying initial claims, because what we've run into with the government programs that came along, when I talk with Doug Tweedy, the Eastern Washington labor economist,
Sure.
we have cases now where people have used up their benefits for the state program, but now they qualify for the other, so they're refiling again.
Oh,
So
sure.
it could be a case there again that we really haven't necessarily had that many more people, but we were trending down and now those people kind of come back again. So I think there's some distortions in that initial claims. I've been looking much more now because it's such a stark difference, looking at the continuing claims. How many
Okay.
people are still having to file for, continuing benefits? And especially when you look at the national level, and Spokane isn't dramatically different, but the national example is we're showing that we're short on the job side about 7.5 million jobs from where we were last February.
Sure.
And yet we've got almost 17 million people still receiving unemployment benefits. What that highlights to me, because of the government programs where people who don't normally qualify for unemployment, the contract workers, the self-employed, the gig economy, people like that,
Right.
that's telling me that now we're seeing a real insight into what's the true labor market, because they don't get picked up in the normal labor things. You're not working for a company, you're not officially laid off, you don't qualify for unemployment benefits. But if we're saying we've got 8 million, and where I look at even more so is just onto the state continuing or the national continuing claims program versus the total continuing claims
Yeah.
when you roll in the government. The national is about 4 million people on continuing claims, and yet we've got 17 million total. It's telling me we've got 13 million people that don't normally get caught in the data that's gathered every month. That's our underground economy or our gig
Mhm.
economy. And that's where I've been just watching much more closely, saying we really need to see some progress there. And that's been much slower, which tells me that these people either still can't find work, or if they're self-employed and things like that, they can't make the numbers work yet to actually try and go back and start a business up or do that type of thing.
They're
So-
still struggling. Yeah.
So I would say now you need to look at continuing claims more than initial claims.
Sure. Not to get too far off the track, but I wonder if there's a way to track that gig economy workforce better moving forward.
I always say, given all the advances we keep having in technology, somebody's going to come up
Yeah.
with that type of a solution, because there's got to be a way to track them. But because they're not filing W-2, they don't have W-2s and things like that.
Sure.
They just kind of slip below the surface there. And that's why there's always this big debate about what's the real unemployment rate.
Right.
And the official rate, we say it's this number, but when you look at their most broadly expanded one, it's a much higher unemployment rate.
Sure.
So that's an attempt, I think, but it still doesn't fully capture to say, okay, how do we use technology similar to what they're doing now with other ways to measure the economy that might be better able to capture what's the real story on the labor force?
I might have the term wrong. Is it U6 unemployment that measures people who are underemployed?
Right.
Have you been paying any attention to those numbers?
Yeah.
That's
That's the broadest one. U3 is the official one, but U6 includes, like you said, the people that are working part-time that want to work full-time,
sure.
kind of the underemployed, the discouraged people that want a job but haven't looked recently, things like
Mhm.
that. It's still much higher, but it is definitely trending down.
Okay.
But I think once again, even there, that's not fully capturing the other side of the economy, which are the self-employed, the freelance workers, the contract workers, all of them. They don't get swept into that
Right.
database
Right.
because they're not they don't qualify for unemployment insurance. They don't get swept into that data pool.
Sure. Sure. Now I have a lot more questions for Steve, but I forgot to mention at the beginning, we have a question and answer feature where you can put your own questions in. Toward the end of the program, we will go through as many of those questions as possible and really keep Steve on the hot seat, right?
Sure, I'll do my best.
I mentioned that piece that you wrote for us. And the other thing you mentioned, and something that we haven't tracked as much, is the daily travel logs through the TSA.
Right.
And is that something that you've continued to follow,
Yeah.
and what are they showing?
There's two that I follow along with the job side. One is the TSA passengers going through. That clearly shows that travel has picked up.
Yeah.
From its depths, where before the pandemic hit, we were averaging just over 2 million passengers through the TSA process every day.
Sure.
We dropped all the way down to like 95,000 per day.
Really?
Now we're up to about 1.5 million.
Okay.
So what it's telling me is that, one, people are starting to travel now for vacation and stuff like that. Because you definitely saw the surges like for spring break.
Okay.
We surged up and then it kind of pulled back.
Mhm.
But where it looks like we're settling in right now until the business world decides what are they going to do for travel, it's around that million or just above a million mark. And that's just people traveling for visiting, for vacation and stuff like that. But that's an encouraging sign to me. That trend is definitely slowly rising. And
Sure.
that's a good sign in my mind.
Good. So is it your impression that that it's mostly leisure travel at this point, and then we'll see the business travel pick up?
Maybe. That's the big question mark. What will the business travel be going forward?
Sure, sure. Because one of the things that we've written about a few times and that you wonder about is how much of the last year will change behaviors permanently. You know, we've all gotten used to doing things via Zoom and other technological
Yeah.
tools. You know, how much of that will carry forward in the future.
I mean, I can give you just the real life example. For my team, the investment team within
Yeah.
Washington Trust Bank, we would travel to our outlying regions, you know, Boise, Portland, Seattle, and Bellevue to participate in client meetings because we partner with the relationship managers there. Well, there's definitely a discussion going on now saying, well, maybe we don't need to do that as often, that maybe some of these you can just do via virtual because the clients are used to it, while others still require travel. I think all the companies are doing that kind of soul searching and saying, how much of that is value added versus we just always thought we had to do that because a customer would never be happy talking to us, you know, over FaceTime
Sure.
or anything else. And now we've discovered after a year and a half that they're okay with that. And maybe that's going to be
Yeah.
a revised business model. I don't think business travel goes away, but we can
No.
discover that a lot of things that you always thought you had to hop on a plane for take up a whole day to fly to Portland or Seattle or Boise or something like that. You can say now I can take up an hour and a half or 2 hours and still be able to do other work that got lost while you were traveling.
Sure, sure. You know, going back to your presentation for GSI, one of the things that you touched on was inflation. And my impression from watching you at that time, memory from 6 weeks ago, was that it wasn't something that you were terribly concerned about. But since then, it seems like that's something we're hearing more and more about. So where do you stand on monitoring inflation at this time?
So what I've told people is, you know, what changed during that time period is that we passed another 1.9
Right.
trillion. And what I've said essentially is when you stimulate demand, but you don't lift restrictions, so you still constrict supply,
Mhm.
we should not be surprised that we're seeing this, you know, sky high price increases.
Sure.
So the official inflation number doesn't capture all that very well. What I would have told people is, I think similar to what I've told them, my view towards the economy is, we're going to have this sugar high surge of inflation because people got a lot of money from the government. They
Sure.
want to spend it. Now they're discovering that you go on Amazon, what you want 2-day delivery and you get 3-month delivery or it's out of stock. I think that we're going to be facing higher inflation all of this year because the problem is, as a global economy, the US is actually further along in our vaccination process, our reopening process. A lot of the supply chain that we rely on is still, you look at India and you look
Right.
at Mexico and things like that, they are under much stricter lockdown still. So their production capabilities are still
Mhm.
greatly constricted. So until we get the world further along in reopening, I think this could be a year to year and a half issue that we're going to have supply shortages. Businesses are going to have to pass that on to the consumers because they can't absorb that, you know, within their own, especially for small businesses. But I do think as I look at it past there, that it still has the characteristics of being transitory because of the fact that we're not seeing the wage increases to offset the inflation. You know, the
Mhm.
biggest difference I keep telling people with inflation now, even though we've got some sky high numbers, especially for construction and building
Right.
materials, back in the late 60s, early 70s, where we had inflation become a problem, and by the early 80s, it was double-digit inflation.
Sure.
We had far more jobs that had cost of living increases built into the wage structure.
Mhm.
So the consumer wasn't affected because as prices went up, so did their salaries. And we don't have that now, except for maybe public jobs that still have unions. So what
Right.
happens is it's been a self-correcting process. Everybody thought after the financial crisis and the Fed pumped all that money in, oh my God, we're going to have runaway inflation. What we discovered was anytime prices started to rise, consumers had to, they're not the US government, they can't run a deficit.
Right.
So they had to cut back. They had their must, buy stuff. They have to pay their rent or their mortgage. They have to buy groceries. So they have to cut back on their discretionary purchases. I think we have to watch now to see, as this stimulus money ends on September 30th, consumers are back to their regular wages. My suspicion is we're going to discover they didn't get big wage increases. And so we're going to see that inflation starting to drop back just purely because the consumer says, I can't afford it. And then as demand starts to drop off, prices just start to fall. But
Yeah,
it's not going to be pretty for the next 12 months.
sure. You mentioned the stimulus package and touched on deficit. When I've heard local economists talk about the deficit, the federal deficit, a lot of times they're not overly concerned about that. But it's something that I've been wondering a little bit more about myself, is how long can we keep this up? So what are your thoughts on the deficit? Is that become more of a concern to you, or is it?
The deficit's always been a concern for me. Maybe I have a different view working for a bank and
Sure.
growing up in a family that demanded fiscal discipline, taught us how to balance a checkbook when
Yeah.
we were in grade school, that type of thing. But the US right now is the world's reserve currency. And so the reality is, so much of the trade in the world still is done in dollars. And when
Mhm.
those other countries deal in dollars, they want to invest that money that they've got somewhere. So they buy US treasuries because it's safe. They know the US has a rule of law, those types of things. So as long as we're the world's reserve currency, the deficit isn't an immediate problem. But I just simply say, even for the example we've had this year, we've had, since the pandemic crisis, we've had over $4 trillion in new deficit spending, and we've got another $4 trillion on the table potentially. Yeah, right now, when you talk to people in Congress, they say, I don't know what you are so concerned about. We issued $4 trillion, look at interest rates have barely changed. And I just keep saying it's one of those situations that there's no magical point to say, when you get to here, the world changes. But at some point, when the rest of the world starts to lose confidence that the US isn't serious about fiscal discipline, they will come up with a different currency, whether it's a digital currency or something else. And at the point where we're not the world's reserve currency, we have a problem.
Sure.
And I think that's the real situation. Even at these record low interest rates, as we keep piling up more debt upon debt, the compounding of interest there, that even at low rates, you get down the road and suddenly you discover that interest expense is using up more and more of your tax revenue.
Right.
And that's where most countries, when you look at the Greeces, the Portugals, and everybody else, their problem was their debt expense, their interest expense was overwhelming their revenues. And they didn't, they basically had a massive problem then because they couldn't support their society. We're nowhere close to that.
Right.
I keep wanting to say, well, we're probably a good 10 years out. But then I keep saying, given advances in technology, we just need to be aware of that. And a thing that I guess I'm encouraged about is that so far I see the evidence that the younger generations, the millennial generation, and then Gen Z, I guess they can't decide whether we call them Zoomers or Zennials, but Gen Z, they seem to be far more fiscally aware and fiscally conservative when it comes to finances. That may be the case that ultimately they stand up, they raise their hands as voters and say, this can't go on.
Sure.
And I'm willing to absorb the cuts in services that have to happen for that. But right now, that's not the case because especially the boomer generation, especially the older generation, isn't about to say, sure, cut some of my services so that we can try and balance the budget there. So
Yeah.
It's not an immediate problem, but I still think it's absolutely a problem.
So something to keep an eye on. For
Absolutely.
Sure. Yeah. Just as I suspected it. I talked to your peer at VistaCorp recently, Grant Forsyth. Yeah. And after we were done talking, I said, what do you think I should ask Steve about? And Grant said, ask him about loan quality. And I think, not to lead you too much, but I think what he was referring to was concerns about an overheated real estate market becoming a bubble again. And so maybe I should just let you take it from there.
Yep.
What are you seeing at Washington Trust in terms of loan quality at this time?
Well, I'll tell you Washington Trust, and then I just tell you the banking industry as
Sure,
a whole. I
sure.
mean, Washington Trust, being family owned for 4 decades, it's always been our discipline that we're not going to lower our loan quality. That's what got us through the financial crisis,
Right.
being one of the few banks that was profitable.
Mhm.
I think the reality, though, for the financial system as a whole, banks, credit unions, thrifts, is that the regulators never backed off on their regulatory requirements after the financial crisis.
Okay.
That is part of the problem we saw during the real estate bubble of the 2005 through 2007,
Okay.
is that the regulators themselves weren't enforcing a lot of the regulations that should have said you shouldn't be making those kind of loans.
Okay.
So not only did many financial institutions loosen their lending standards, but the regulators didn't come in and slap them and say, no, you can't do that. The regulators have been hardcore, even with this, is saying you have to adhere to the standards. And I think that we're in far better shape. And I know just even talking to our home loan center, or home loan division, excuse me, we just renamed them. We're not making mortgage loans to poor quality. You still have to meet the standard. You have to make your down payments. And that's the other thing, is that the regulators haven't backed off that now you actually have to make a down payment. Where during the real estate bubble, there was zero down, and there was actually over financing versus the value of the house. So I am far less concerned about that. And even looking at during this pandemic crisis, we've clearly seen deterioration for some businesses on the margin. The weaker ones have either been put out of business or have struggled with loans. But as a whole, what we see from the FDIC reports is that we're not seeing a dramatic rise in defaults, or even delinquencies haven't risen that much, because the banking system and the whole financial service system has been heavily still under the regulatory scrutiny of coming in and saying, you better be adhering to the standards.
Yeah.
And so I think that has served a good role there. That the problem with the housing market here isn't a speculative bubble. It is a pure supply and demand fundamental economic problem.
Yeah, it seems like there's, in addition to the financial side of it, there seems to be a number of other things that are different about the housing market now from 2006, 2007, 2008.
I always tell people to remember it wasn't as bad in Spokane, but it happened. But clearly, I can remember in the Boise market and other places during that bubble, you go into a new housing development, and within 6 months after filling up, technically, there's 4 rent signs on like every other house or every third house. So you knew that it was investors buying those houses, figuring that they could, fix them up. They can either earn money off it or they could flip them. And you just don't see that.
Right.
And that's the fundamental difference, is that this isn't being driven by speculative investors. This is being driven by a lack of supply for a variety of factors going on there, but it's not the speculative side now. It's a fundamental side.
Very good. So as you think about the next 6 months, we've talked about a number of the challenges that we have that will likely persist throughout the year. What are some of the economic indicators that you're going to be paying the most attention to in the back half of the year?
My grounding always comes from our economic growth in the US is almost 3/4 driven by consumer spending.
Sure.
So I always ground myself with the lens that I look at the economy is first, what's going on with jobs, because jobs create income. What are they doing with that income? Because income is the fuel that consumers use to spend. And so one of the things they have now with these advances in the technology that makes it at least better to see closer to real time what's going on. There is a partnership put together. It's called the Opportunity Insights Project.
Okay.
Anybody can see it. It's tracktheeconomy.org if somebody wants to go out and look at it. But they're tracking with closer to real-time data like credit card usage, mobility, like with the Google Maps and things like that. So I'm looking at that because the problem with the US numbers is that we won't get April's numbers till May at the earliest to say what happened with the consumer.
Sure.
I can see more real time with consumer spending, what's going on there, because they've got data through almost the middle of May. So I'm going to be looking at that. Is this a sugar high? And what we've definitely seen is a very clear pattern so far with these stimulus checks. You get the surge in spending for a couple months and then it drops back off again, and then a surge and drops back off. So what I want to see is we've got that last surge out of the way, or it's in the process of being out of the way. They got their money usually by the first week of April. We saw that surge in April, and so far May has still maintained that. I'm going to be looking to see, does it then drop off, or does it show strength that it's slowly growing? I'd much rather see a slow, gradual improvement. That tells me it's more fundamental. These big spikes like that, it's like, nah, that's going to go away, and it does.
Right.
So I'm going to watch, like I said, both the jobs growth reports, the continuing claims report to see if we're putting people back to work. And then I'm going to be looking at that spending data to say, what are the consumers doing with their money? Are they spending it? Are they saving it? You know, because what we've seen so far in some of the surveys they've taken is the consumer has spent about 40% of their stimulus checks.
Okay.
Instead, they're using it to pay down their debt. They're using it to rebuild their savings that they had to draw down when the pandemic first hit, or they're using it to build savings they never had before. And some of them are using it to try and build a retirement foundation there. So I'm going to be looking for that type of thing too. Is it going to spending, or is it going to other purposes, which is good for the consumer, but it doesn't help economic growth because it's not resulting in more jobs growth from people spending and buying.
Sure. That makes a lot of sense. Paul, are we ready for questions for Steve?
We've got a couple, and then we'll get it back to you. The first one is from Lars Gilberts. And hi, Lars. 6 weeks ago, you brought up a post-sugar high, just mentioned that, economic decline in the coming years. What level of growth or policy interventions would be needed locally or in Washington to avoid that, quote, crash?
So let me clarify when we say crash, because what I was laying out then, which I still believe is the most likely scenario, we have a real strong year this year, especially the second half of the year leading into next year. But then as all of that temporary spending goes away, we drop back to 1 to 3% growth. What I would say from a policy standpoint, what we need to see is what I call the difference between unproductive debt and productive debt. Unproductive, I'm not making a social commentary because it was very much needed because of the crisis, but unproductive is giving people stimulus checks because that's temporary. It's not a sustainable income stream for them to be able to actually contribute to the economy. Things like the infrastructure package that they're talking about, the true infrastructure part, that to me is the type of things that I think cities, governments need to look at, of saying, if we're building new streets, going somewhere, let's say like finishing the north-south freeway, something like that. What we have seen very clearly over history is that when you build a new highway, a new freeway, within a couple of years, the on-ramps and off-ramps, you've got restaurants, you've got hotels, you've got different things like that. That's bringing in new businesses, which means new employees who are getting new income. And that actually is a sustainable contributor to a community where they grow their tax base, they grow their revenue base. I would also advocate, without having any perfect solutions, that we should really focus on how do we better target small business and get them back on their feet, get them contributing, because small businesses, except for the large super metropolitan areas, small business is the lifeblood of a city. And they have been damaged the most during this pandemic, and they've had the least amount of revenue replacement compared to the publicly traded companies who can be out there borrowing at dirt cheap debt levels. So whatever we can do, whether it's improving regulations or whatever else, so that small businesses can get reopened, have the chance to be a success, encourage the creation of new small businesses, because small businesses over the last 35 years have contributed about 60% of all jobs created in the US. And at least before the pandemic, they accounted for almost 40% of economic growth. So I would say, without any absolute answers to give you, focus that money that we're getting on how we can support small business, get them back on their feet, and get them contributing back to the economy. And that's going to give us sustainable growth that potentially could be above that 1 to 3% level.
And a question from Mike McBride. Can you speak about cryptocurrency and your thoughts on its role in the economy? Some large banks are now advising investors to make it part of their portfolio, but the speculative nature of the asset remains highly volatile. Also, it looks like the Pondere newsprint site may become a crypto mining farm.
So I always tell people cryptocurrency is an absolute misnomer or mispricing. Bitcoin and all the other crypto items are not a currency, but they are an investment. And so it may make sense for people who want to put that into their portfolio, but it is an investment that is going to be highly volatile. And it's got to be someone who's got that type of risk tolerance to say, I can have Bitcoin where in the middle of April, it was worth $65,000 per coin. Yesterday hit 30,000. Today is at 43,000. I simply say there's no way that's a currency when you have that kind of swings in values, because most businesses would say, there's no way I'm going to take that. Because imagine, I think even for Tesla, who said, they'll accept Bitcoins for Tesla. Imagine Tesla sold somebody a car and the person paid for it in mid-April with $65,000 Bitcoin. And if Tesla didn't convert that back into US dollars, well, they then have had a 50% depreciation in their proceeds they got for that car. So I think that's why I just say I really struggle when they call it cryptocurrency. It might be crypto barter because you do get some people to agree to trade back and forth of that. But until it's better regulated, until it's a stable value that you're not having a case of saying, what's my dollar worth today? Oh, it's only worth 10 cents on the dollar. Oh, wait a minute, now it's worth $3 on the dollar. Most people don't want to deal with a currency that have that kind of fluctuation. So we can't deny the digital currencies. I think they're delivering a message for us that people are tired of government manipulation, this world central banks holding interest rates towards zero, things like that. Maybe 10 years from now, we're going to have a independent digital currency that people are willing to use. But the Bitcoins, the Ethereums, and all the others, even though we call them cryptocurrencies, they're crypto investments. And as long as you understand that and you can live with the volatility, I have no issue with them as an investment. I have a big issue when people try and tell me it's a currency that we're going to have everybody adopting as our form of currency until, like I said, we get some stabilization and some regulations.
Just one other question at this moment from Bob McKean. I think you touched a little bit on loan quality, but his question is maybe in a different context. And that is, what is your view on loan quality given the foreclosure hold expirations?
Oh, good question.
I think that's the big question mark, is what happens when the moratorium gets lifted. Foreclosures themselves, I think we may not see that to be that big of an issue, because what's going to happen is they're going to add that what's been the forbearance, they're going to add that to the back of the loan, and you're going to have to pay that back, and you're going to have a longer loan period there. I think most financial institutions, as long as they still feel that the person that they're dealing with has solid credit quality, that they were a victim of what happened with the pandemic. But I do think that the others may be a case unemployed. They're not going to be able to reinstill that of making payments. That's something that we're not going to find out until we lift. Similar, like I said, we won't know the true damage of small business. We won't know the true damage to the mortgage market until they actually lift the program. Because what we've seen so far, tracking the forbearance program, people coming out of the forbearance have actually, the majority have resumed making their mortgage payments. But there is definitely a group, but it's a very small percentage so far, that have gone into foreclosure. And whether that accelerates, I worry more, kind of the ripple effect. I worry more about the rental market and people, potentially being evicted there, because a lot, especially when you look at Spokane, but other markets too, a lot of those rentals are private individuals who purchased, 4 or 5 houses as retirement income, or they own one apartment complex. They still have to make their mortgage payments. And that's where I think we could see the loan problems with mortgage payments, is that ripple effect, that when you lift the moratorium on the rents, we discover a bunch of people can't make their rent payments, they get evicted, unless the landlord can find new people, which right now is not a problem, but that doesn't guarantee it continues. It could actually be the private investor who is a mortgage holder on their rental properties that gets washed out because of the fact that they didn't get any big aid, or they didn't get any forbearance for their loan issue compared to the single family residents that had the forbearance program in place.
So
We
kind
do
of-
have, I'm sorry, we do have one more question from Lars Gilbert. Sorry to interrupt. How would you define a real local economic boom? And do you think Spokane is positioned for this?
I think Spokane is well positioned. I think Spokane is already seeing some of that signs by the stress that we have in our housing market. You know, what's happening now is when people have realized that they don't have to work where their company is located. We're seeing people moving to Spokane. The word of mouth is spreading and saying, hey, you know, great quality of life. They do have all the different amenities that you're looking for. I think that Spokane is well positioned, and there's, you know, we're hitting the radar now on more of these rankings for most affordable place or best place to live, things like that. Spokane's big challenge there. To Lars's question, you know, what do I define as more of a boom there? One, we'll see it in the jobs growth, and what I'd be looking for there is the diversity of the jobs growth, that we're not heavily dependent on one industry or just a couple of industries. We start seeing businesses moving here that give us better diversification. We see people moving here that work for a different type of company, come to Spokane, have a different income stability versus what we might have otherwise, and raise the overall average hourly earnings for Spokane. I think that's when you really start to say, okay, this is, you know, this is sustainable. This isn't a temporary government money being paid to people. And I think I just look at housing as my biggest gauge there of saying that when we have such a shortage of people wanting to buy houses, that's a good sign. And when we see that, you know, downtown office buildings are being converted to multifamily apartments because there's so much demand again, that to me is a good sign. It's a healthy sign, but it's something that Spokane's going to have to grapple with, that the city as a whole is going to have to understand that with growth comes pain, you know, growing pains. And if we're going to fight every new development or fight any taxes to build out our infrastructure and stuff like that, ultimately people will pass on Spokane and move on to a different city. But right now, I think the trends look very good for Spokane.
Great. And from Toby Bromeling. Hey, Toby, talking about unemployment, what will the workforce look like, especially as many small businesses or business owners rather, are navigating the tension between the currently unemployed versus many of their positions going unfilled?
That's a tough situation for small businesses. And that's where all the blame is saying that, well, the government gave too much money for unemployment benefits. I think that's going to be something we're going to have to continue to watch, because the reality is, when you look at the numbers, you do the math on the numbers with that $300 a week extra payment. Essentially, if you make $35,000 or less, you're making more money being unemployed. But if you're not making enough and you still need that type of support. I think that's where the tension is going to be. Unfortunately, that centers primarily in leisure and hospitality. I mean, traditionally, that is the minimum wage type of job. And what I worry about is how small business is going to resolve this. I mean, at their nature, small business are entrepreneurs. They adapt, they adjust. I have trouble seeing that you're going to see en masse a lot of the small businesses willing to raise their wages to bring these people back to work, because once you've raised the wages, you can't then drop them back down again when we reopen and that $300 a week goes away. I think what you may see is that these employees who are refusing to come back to work, it's going to be a case of small business, because they're saying, I can't wait till September. They start investing in technology so that maybe you don't need a greeter at the restaurant. You have them deal with a kiosk or something like that. Maybe you don't need as many food servers because you install tablets at every table and the people can order directly from there. So that's what I worry about for the unemployed, is that on one side, I fully understand why they say, hey, I need to make as much money as I can. But I think they really need to be careful and evaluate, if I still want to go back to that type of job, is it going to be there when the money runs out? Because either the small business has gone out of business, or they have adapted with automation or technology and no longer need you to come back to work because they've got a computer doing it for you instead.
And from Scott Abel, hey Scott, it's been a long time. How much do you think the worldwide shipping issues will impact a potential recovery?
It's already impacting. I think that's the real problem we're seeing here, is that the impact right now, even though the economy is strong because of the stimulus money, that's what's causing the big rise in prices. We've got cargo container shortages. We've got the ports throughout the world, including the US, that are backlogged with goods sitting either on the docks or, go to Seattle or go to LA and look at all the ships just lined up waiting to come to port, because the ports themselves are still under the COVID restrictions. They're not fully staffed. So I think that's going to clearly have a problem. And the issue with that is that with these rising prices, you could hurt the economy right there, of slowing the economy with that. But I also think it's going to take some time to clear out those shipping problems. And it's not going to just be an instant type of thing. When you make a commitment as a shipping company to decommission ships and things like that because of the effects of the pandemic, you don't just throw a switch and say, okay, I'm going to bring 10 ships back online. If you've decommissioned them, there's work to be done there. So I think that the supply chain problem is going to be one of the weights against the economy. It may not be sufficient to slow it dramatically, but it'll definitely be a drag on the economy. And I think that's something we have to continue to watch, because we're a nation that wants cheap goods. We're not willing to say we're only going to buy in America and we'll pay far more than what I can get from Amazon by having something that was made in Vietnam or China or Malaysia or something like that. So as long as we're a global economy, we're very dependent on the supply chains and the shipping channels operating efficiently. And I think that's going to be a while to recover that.
And one last question, and this is from Lars, but it's a good one, so we're gonna give it to you, Lars. Northern Idaho is experiencing significant growth compared to Spokane. How much is this a win-lose proposition versus a regional growth opportunity?
Well, right now, the difference is Idaho made the decision, and each state made the decision. I mean, that's one of the problems that I always had as an economist. We did not have a unified national response to the virus situation. Idaho made the decision that they were more focused on the economic growth, maybe because they have a far less dense population as well. But Idaho lifted their restrictions far faster. Idaho is now completely out of their pandemic stages. So they're fully open, no masks, nothing like that. And the reality is, I think as all of us know, if you made trips over to Coeur d'Alene during the pandemic, there was very much the belief that the pandemic wasn't real, that the mask compliance was heavily fought in Northern Idaho compared to Spokane. And so they traded off there. If you look at the medical data on a per capita or per person basis, they have a far worse situation or results on the medical side, but a far better result on the economic side. And that's where I've tried to have conversations with politicians, that we got to find the right balance. Idaho made the choice, let's focus on the economy. Washington made the choice, let's focus on our people and keep them healthy. And that's why we've got this difference. And the real issue, which we'll never know the true answer to, but when you've got 30 miles away from you an economy that's fully open and nobody following medical protocols, well, it could very easily be the case, and I'm pretty sure it was the case, people in Spokane who were frustrated because they had to wear a mask or they couldn't go to restaurants because they were locked down or restricted, could drive over to Idaho, enjoy all of that, come back, not realize they had the virus because they were asymptomatic or something like that, and continue the spread in Spokane, where Idaho looks like they're doing fine there. So I'm not going to pass judgment or anything else. I simply say Idaho made a different decision than Washington. I think we'll still see, once the full restrictions are lifted, Idaho and North Idaho and Spokane still is a regional combination there. And I think that we should still see opportunities there. But right now, it's two different worlds. If you go to Idaho compared to, and unfortunately what you get right now, at least what I experienced one time, is because the bank still has a mask mandate. So when I go over to our Idaho branch and I have my mask on, I'm giving all these dirty looks by everybody else who don't have a mask. And it's almost like I better take my Washington plates off right now and put some Idaho plates on. But I think that's temporary. I think, again, once we reopen the economy, we get back to economic fundamentals.
Right. Well, thanks, Steve. That was
Absolutely.
really good. Thank you to Lars with the hat trick on the questions. Mike, Scott, and Toby for weighing in with some great questions for us. Thank you to Marty Dickinson and her team at STCU for sponsoring our event today. And thank you all for joining us. You have a good evening, and we'll see you in June. Thank you.